I see some green shoots.
We need to have some kind of stupid bar.
I just think this is a classic structure, Lamont.
And I'll show you guys, a little trick here.
When you see some of the stuff that we're working on, you're going to like it.
Welcome, Wyckoff Nation, to Wyckoff Market Discussion. This is December 1st, session number 48, episode 275. In the upcoming events, tape reading with William and myself every Monday at 9 a.m. Pacific. Check this out on our website. Stock Charts TV is airing power charting episodes with Bruce every Friday at 3 p.m. Eastern. And today we have an open door class. So we have a promotion going on for 1 week. Instead of $99, it's $79 per month. For those of you who will be interested of signing up, go to our website, wyckoffanalytics.com, sign up. We will be happy to have you as part of our community. This offer will expire next Wednesday, so you have 1 week to do that. Hi, Bruce. How are you doing today?
Hey, I'm great. Thanks. Good to be here. Good to have all our guests, too.
Absolutely, yes. And we have a lot of material to cover today. But we have one announcement, Bruce. As a member of the TSASF, as a board member, and you being the chairman, we obviously know what's going on with the TSASF, which is the local technical analysis organization in San Francisco, in Bay Area. One of the oldest, by the way, technical associations in the United States. And we have a very interesting event in December, the Roundup. So could you, like in one paragraph, tell us about what this event is about?
Well, we are trying to sort of recreate the intimacy of our get-togethers when we would get together at Golden Gate University or somewhere around the city and get local members together and talk about issues. So we would have a roundup in December, and this is going to be a panel discussion. It's going to be composed of our local people, and we certainly encourage other local people or TSAA members, because local is literally, we have members around the world, and to contribute, to become part of these. We hope to rotate out people every time we do this. And so we have a great cast of characters this time. I'm the least important. I think I'm sort of the MC of this thing, but two very old, longtime members of the society, Larry Amernick and Joe Turner, are two really, really good researchers on all things financial liquidity. And so both of them, from their own perspective, are going to break out their financial liquidity models. And Larry Amernick is going to talk about a way that he's been able to effectively create a custom financial indicator about liquidity from information that the Fed no longer publishes. And so, which he considers to be very, very important. So that should be phenomenally interesting. And so this is just going to be, a great informal session. Hopefully we'll have time for a little panel discussion at the end. And I encourage you all to be members. It's not expensive to be a member of the TSAA. It's a great community, and we're going to do some really cool things in 2022.
All right, sounds great. And Bruce, thank you so much for covering this. Let's jump to the markets, because this is why we're here, and this is what of interest to us. All right, let me just get to the correct screen. Okay, so here's our usual screen here, and as you guys could see, kind of majority of them, if not all of them, except maybe for Bitcoin, is down. So it's going to be a very interesting discussion today. We're going to start with a little bit of the review of how we viewed the market and what conclusions we had before this slide, so that everybody would be caught up on our thinking here. So we're starting here with this particular bar. And of course, in Wyckoff methodology, not only do we look at the structural analysis, we also look at the price and volume analysis. So a bar by bar analysis or swing by swing analysis is extremely important to us. So if we would start with the bar by bar analysis, on this particular bar, we're noticing somewhat of a slight increase in volume signature. And also we are observing that there is a supply tail. And this indicates to us that supply is emerging at this point, and that is suggestive that we're going to have some kind of change of behavior reaction. On this change of behavior reaction, we need to have a change of behavior bar. So here it is. This change of behavior bar is going to be associated with the increased volume signature, with the increased selling, and also it will negate a couple of closes or significant bar closes to the upside, which we do have. So the last two bars with progressive closes to the upside were reversed by this change of behavior bar. Now, it was very interesting to observe that despite of this change of behavior that was suggestive that we are in some kind of trading range environment or in some kind of reactionary environment, it looked somewhat bullish with the demand tail at the bottom, and obviously this volume increase. It's not just the supply that is coming in, but demand is also increasing at the same time. And what we're seeing next as the trading range develops from these two bars, that the rally is not capable of committing to the upside with the closes above the close of the buying climax, with the high of the buying climax. We have multiple attempts to do so, and on the last two attempts, we have an upthrust situation on both of the bars. And with that upthrust, supply comes in again. And when we see that, our anticipation is that we're going to have a reaction to the support at the minimum. And then obviously, the big bar on Friday in thin market, and you could definitely discount that, but there is so much ease of movement to the downside, and supply is still increasing, and that's in a thin market. But even before that, there was a very interesting bar here to the upside. This was an attempt to stop the reaction of the upthrust, and this was an attempt to still commit above the level of the resistance, which failed. So this failure, together with the Friday bar on the increased supply signature, was suggestive that we are experiencing more of the sign of weakness. We were discussing in our classes whether, what's the difference between the sign of weakness or a potential spring. So spring would come back to the trading range and would continue, the price would continue its movement to the upside into the area of the resistance. We don't see that here. On Tuesday, yesterday, we are negating that spring situation with the new close, which is below the low of the Friday bar. And that still suggests weakness. And not only that, we're seeing that institutions are selling more and more. And it's kind of logical. And we've talked about this in different classes. We've talked about this last week in the WMD. It's the end of the year. If there is any excuse for institutions to start taking profits, to start selling laggards, and to rotate the portfolio and secure their bonuses for the year end, for this year, this is the time. And obviously, the news cycle is very favorable, not only for just selling on the news, but also selling as the reason. Catalyst is acting as the reason for them to sell and to take some profits. And then today, a very interesting attempt to rally. We were seeing a lot of buying at the beginning of the session, and then again into the end of the session, we're sliding back. All right, well, Bruce, let me ask you this question. Do you think that the current reaction is trying to find some kind of bottom around the area of the support that was created by this latest uptrend stride, or could we potentially break to the downside even more?
There's two things that sort of disturbed me about this latest rally, especially off the early October low, is that this whole, really this whole rally from the beginning of October up to the final high has somewhat of the character of climactic behavior in it. So notice just the sheer number of green bars on the way up, and it just persistently goes higher and higher and then accelerates at the end, but also it does not accelerate into the top of the channel, which in and of itself is a sign of loss of momentum. And there's you could make the case that there's a diminishing thrust from the early September high, that the high that was made in early November from early September is a smaller move up than the one from May to September. And so Hank used to call this poor man's momentum, but it really is a beautiful illustration of the loss of momentum in an upward trend. And the combination of that with this climactic behavior into the final high and this little acceleration in early November, which then became range bound right away and then had a series of tests before failing, really gives me the concern that this support, that what we call the demand trend line in this channel, overbought line and a demand line, is I think at risk. And so I think what we would see here is either a pause on the demand line, and then it rides along the demand line, has a rally of very poor quality, or it even just outright breaks through the demand line and then rallies poorly up into it. And so those would be the two conditions that would really worry me about the ability of the market to continue lower from here. So what we need to see is we need to see something as happened in September, where you had a late September low, and then you had some volatility, and then it just started to just rally up from there, and showed the capacity to be able to continue to rally. If people, I don't know if we have this chart today, Roman, but if people will look at my blog that I published this week actually, they'll see a point and figure chart of the NDX, which also has this upward striding trend channel, and that trend channel is at risk of failing. So the NDX is at risk of failing back into the channel. And so that would be the ultimate test for me. And as of today, it's resting right on it. So just, that chart is in that blog, and everybody can go look at that.
All right. Well, couple of other things of importance. And again, I wouldn't go there just because I've been showing you guys this for quite some time. Since September, we were looking at this analog. And I think I kind of like beat it to death. 2008, 2009 low, the way how we approach the 2010 flash crash is kind of similar. And it's similar just because of the behaviors of the institutions. So we have the first momentum wave, we have the second vertical absorption, where there is a lot of rotation is happening. And then we have a very interesting reaction, which is reminiscent of what we've just had in September. So in September, there was a question, in my kind of perception of the market, and we've talked about this with Bruce, was that we could react to the downside. But then when we studied this analog, it kind of became obvious so that we could have the last leg to the upside, which could have that climactic character that Bruce mentioned about. This is where almost each day we have gains, but the volume signature is going down. And then a very small distributional top, which on the intraday obviously is going to be much more visible, and then a very rapid decline into the previous support area. So why would be decline be of such character, where we almost have kind of like a shakeout action. Again, think about institutional behaviors and how sometimes when everybody's so bullish, and they are starting to sell, let's say, some lagging stocks, and the decline comes really fast, unexpectedly. The institutional crowd, starts to sell aggressively down, and they want to get out as soon as possible. So we kind of observing almost the same behavior here, where we had the initial reaction in September that already showed some weakness, and then we have this shortening of the thrust, shortening of the momentum in the context of the whole uptrend, and we're seeing this kind of like very attractive rally, lots of money being made in October into the mid-November. And now they want to take the profit on the catalyst. And the verticality of this decline, this 4 days since Friday, and also the volume signature is suggestive that we're probably gonna continue to the downside, or at least attempt to break the support. Look at this verticality and look at the verticality of this reaction. So we're seeing how this reaction is definitely has less selling, less aggression. So with this type of the aggression that we're currently having on the reaction, I think, Bruce, that most likely we will try to break the support. Okay, well, if S&P is close to this uptrend, Nasdaq is being the strongest, and we are just creating a breakdown bar and trying to commit to the downside. The volume signature is not that impressive, but there is most definitely some selling. And I think, Bruce, that there is less selling in Nasdaq is just because it's stronger, so institutions are trying to keep more positions in technology stocks rather than in anything else. Or with Nasdaq also, like let's say with Nasdaq 100, the big mega cap stocks are holding the index a little bit better, and that's why we are observing that strength. What's your view on that?
There's that old saying on Wall Street, beware when the generals march alone. And what that meant was, in the old days, was that these were the generals were, of course, the really big leadership stocks. They were largely in the Dow Industrials and also in the S&P 500. I think the big leadership stocks today are in the Nasdaq 100, and we all know what these stocks are, and they are mega caps. They tend to really dominate the performance of the indexes because of their sheer size of capitalization. And they are the stocks. What happens, and this is what this term meant in its day and still means today, is that what it meant is that the money that flows into the market goes into a narrower and narrower list of the most premium, best names, the best performing large cap stocks. And so I believe that that's what's happening in the NASDAQ 100 here. But Ramon, this looks an awful lot to me, at least on a minor scale, like distribution, because you can see in early November, just as what happened in the, what happened in early November was there was a climactic acceleration, and then after that, range-bound condition. You can see there, look at the sort of a climactic acceleration, then an automatic reaction, sets up a range-bound condition. These are classic conditions in Wyckoff either reaccumulation or distribution structures. And so here we can see that there was one final attempt to go into an upthrusting action in the middle of this structure. And what do we know about distribution? Now, this is obviously on a very minor scale. So this is not distribution on a gigantic scale, but it does say this could be the short-term direction of the market. Is what do we know? We all know as Wyckoffians that the volatility tends to increase throughout the distribution structure. Tell me that isn't what this looks like. And so look at
Yeah,
the
for sure.
volatility here off of that upthrusting action
Hmm.
and
And
how it
especially
just,
in this area right here,
yeah,
the
exactly,
volatility. Yeah.
exactly so. So that to me is a sign that stock is not in strong hands. Stock is being distributed and that it's going into ever weaker hands, and it's in the ever weaker hands that produces the increasing volatility. And so this to me is, I think, at least on a small scale, indicative of the potential for lower prices. And lower
Hmm.
prices may mean nothing more than getting back down towards the demand line on the
Yeah.
Nasdaq 100. Time
Yeah,
will tell.
and in this case, I mean, like we look at different market indices, right? So S&P is most definitely close to that support uptrend channel line. Nasdaq still has some room to go, and it's just a reflection of the strength. So if we're gonna have a reaction here of kind of like shakeout type of action, where we have some kind of stupid bar, right? So something like this, maybe with the tail. I would be thinking that we are touching here the support of the previous reaction and maybe going slightly below this, but recovering. And then the biggest question becomes is, well, if this was the climactic action, then what's next? What's next? That's the biggest question. Well, assume that we are in a small downtrend right here. Maybe we're in this kind of like this cyclical correction of 10 to 20%, right? So this constitutes a change of behavior to the whole trend that we have had. And it should be much more profound than this reaction, which is a little bit scary because I remember September 2nd reaction last year started, and it was just like a major correction that we have had in the technology stocks. So if we have this change of behavior, that would be suggestive of the change of environment from the uptrend to a trading range. So we could have something what we've had in 2010, like a quick flash crash, shakeout type of action, and then off we go into a trading range. And then again, the trading range would be created according to the strength of each index. So for instance, if we will switch to the next index, which is the Russell, we are seeing that this cyclical correction of 10 to 20% is already underway. And I think that the key, Bruce, for me was just the break of this long-term trend line that we have here that was supporting the price movement to the upside. We upthrusted, and then we started to go down. And that was a very interesting observation that we did in the tape reading class, where we said that it's somewhat similar to this area right here. Let me just clean this up a little bit and increase the view. Okay, so look at how the price slides and how supply is increasing. Kind of the same here, right? And at the end, we have this stopping bar, stopping action. So almost kind of like a mini climactic action. The intent is just to stop. But what it does, it breaks down a very significant, commits below a very significant breakout bar. In this case, this was the bar here. Comes to the support, should rebound from here, yet commits to the downside, and then it acts positively, the rally goes to the upside. So with the same logic, we're thinking, okay, well, this is the bar where demand most definitely comes, and maybe this could be a stop in action. If this is a stop in action, then the price should behave the same way. The price should start going up and trying to test the upper parts of this capitulation bar, and it did not. Right on this second bar after the stop in action, we have a slide, we have a commitment to the downside, and this bar negates the whole idea that the stop in action could be bullish. So it's a very interesting development in Russell. I would be saying that looking at S&P and Nasdaq, we might be saying, well, maybe we're at the beginning of the correction. With Russell, small stocks and also, kind of like a high growth stocks, and we'll look at the ARC chart today and compare this to the 2000 analog of Nasdaq. This is already in the corrective mode, Bruce. So that's kind of fascinating how the strength and the weakness develops the structure.
Yeah, the only thing I would add here is that, of course, this is looking as though it's a classic upthrust after distribution type structure. And what has to happen when you have a breakout, and the reason that upthrusts after distribution happen at the end of long uptrends is because they can trap the breakout buyers. And so the breakout buyers come in, they buy either in the structure or on the breakout, and then the market starts to melt away back in again and starts to accelerate. Now, upthrust after distribution means that distribution has occurred all the way through here. And so there is tremendous weakness that ensues because the stock is in weak hands. That's the reason we're getting acceleration. This is a lesson for us because, hey, it's okay to buy breakouts. It's okay to buy breakout candidates, always with the notion that you have to be ready to be a good risk manager because of the UTAD characteristics. And if this all is distribution, then it's not going to stop at support. You know, yeah, it'll have bounces along the way, but it could be that it goes into a more pronounced downtrend. And that is, I think, considering the Russell and the importance of the Russell as an index, that, you know, could be telling about what the future holds.
I actually have some thoughts on this, Bruce, because when we were discussing this area right here, I remember our analysis of this area. I mean, we clearly were stating that this is a reaccumulation type of structure. Why? Because the volatility was decreasing relative to the previous structure right here. So there are two structures here in this larger trading range. We had a very favorable bullish approach here. We said it's going to go up. We saw a very good test on the next low. We said it's going to go up. This was a little bit concerning, and I was a little bit, questioning what's going on here, just because of this capitulation bar. But the price resumed its move to the upside and broke out, and we saw a last element of absorption around the breakout area. And as we go up, the demand is coming in. So to me, this whole area looks bullish. And I think that, in our Wyckoff methodology, there is a misconception as to how the upthrust of the distribution occurs. I would label this probably as an upthrust period without the add-on of after distribution, because I would be questioning what kind of distributional signs do we see here in this area. And my argument would be that we are seeing distribution on the way down. This is just not something that you would regularly kind of study in the method, and this would occur not very regularly. So we're seeing how supply has increased so much as the price started to move down. But before that, there are a lot of elements of the reaccumulation. And that's why the velocity is increasing so much for the price and the momentum is increasing so much, is because they are not distributing throughout the whole structure. They're distributing off the high down. And that's kind of like where I am with this, Bruce, right now, in terms of the upthrust of the distribution and also the distribution on the way down.
Yeah, I think that's a phenomenally good point, and it really reminds me of some of the readings from the old great traders of the turn of the 20th century.
Mm-hmm.
That one of the playbooks of that era was to run up a stock as high as it would go, and then distribute the stock on the way down on a scale down off the peak. And part of the reason for doing that was because there's liquidity there's actually liquidity because the public comes in and buys the initial leg down and wants to own the stock in question because they think it's a bargain. And so they're able to sell stock. And the other part of it is that they never knew how high was. And so a stock may just go higher and higher and higher, and they want to let it go up as much as they can. So the case for distribution on the way down is very real. And maybe we get down to the support area and then the volatility builds after that. Or maybe that's the end of it. Maybe it goes down to support or slightly through support, and that's it. I don't know, but at this point, clearly there is supply present because we can see it in the volume and in the very wide-ranging bars.
Yeah, it feels to me like we should have some kind of even more meaningful capitulation. Again, something stupid where we have a bar like this. So on Russell, it would be more dramatic just because it's weaker, right? And then we would have some kind of, very, very big high volume spike type of bar right here. And then we'll talk about what this whole decline is. So probably a sign of weakness. Usually after that, we have, again, consolidation. We are not necessarily going down, down, down. It's going down, stopping, consolidating, redistributing, or absorbing, and then, doing the next thing.
Yeah.
Okay.
Which is
well,
classic.
Bruce, yeah, let's look at the Dow. So what are your thoughts on the Dow? So definitely weaker than S&P and Nasdaq, but not as weak as Russell. So what's your view of the Dow?
Well, the Dow again has had it built a really nice accumulation or base type structure on a very small scale there from mid-September to mid-October, and then rallied off of that. And I think that we identified that early on, and it did produce a nice rally, which did go up into an upthrusting action. Now, if you draw a trend line off the peak in May, the May peak, which was a climactic, and then also the August peak, right there, you had a slight throw over of that level, which was a classic overbought condition. And then from there, look what it did. It failed right back in, and now it's right back down to this upward sloping structure. So maybe there's a combination of support back here in September, October, and also in this upward sloping trend channel. And so I would be watching for that, probably go through it in here, and then maybe the ability to come back into it again. But an interesting place. But again, supply is present, and downward it goes. And the Dow has not been leadership. As a matter of fact, if we recall, we do a lot of we check in on the bullish percent numbers with these different indexes from time to time, and the bullish percent on the Dow has been persistently declining all the way through this period from early November, and it's just down, down, down. And as long as the bullish percent data is dropping, we give the downward trend the benefit of the doubt. And conversely, if it's rising, bullish percent is pointing up and rising, we go with the upward trend too. And so certainly it's down right now.
All right. Okay, so let's jump to some other markets of interest. Let's start with US dollar. And Bruce, you brought to our attention, and I wish we would have that slide, where you had the analog, not the analog, but the comparison of two markets, the dollar and, oh boy, I forgot what it was. But basically, you were suggesting that we're going to have, and that was back in September, October, I believe. You were suggesting that the dollar might actually rise, and then that the market just, on the rise of the dollar might have some kind of, increased volatility. So, and here we are, the dollar is going up. So your PNF, I believe, as we were discussing it back then, was showing the target somewhere in the 28 in the $28 mark. Is it still ongoing?
Well, and look at this beautiful accumulation type structure that goes all the way back to August of 2020. So this is like a really big accumulation, and this actually is not necessarily good for the economy for exporting. So for instance, because a strong dollar actually makes our goods more expensive for export, et cetera. So it might actually have the effect of putting a weight, so to speak, on economic recovery. Maybe not necessarily dramatic, but it they generally like it when the dollar is flat to falling, because it makes exports look like better bargains. But here you can see this beautiful structure, which I think is evidence that the dollar is being seen as a safe haven, and that this is where international currency flows are going, and because people are trying to protect their purchasing power. And ironically, the dollar is the is the place to be. And so notice off of the May-June low how you've got this really nice jump upwards rally, and the consolidation becomes ever narrower, and then it goes into another uptrend. And so each one of these has a lack of volatility in it, which shows that there's good support and good demand underneath the market for the dollar as it goes higher. So and also note now that it's above the September 2020 high. And this, that to me is like kind of important resistance, and it just jumped right through it and backed up to it. So this is just, the structure looks very attractive in terms of the dollar being able to continue to trend higher, go sideways and trend higher for the foreseeable future.
Yeah, definitely looks like it wants to go higher, and obviously the targets are going to be all of the highs during the COVID-19.
And the other thing, Ramon, is this will tend to tamp down inflation. So the effects of this is that there's other reasons to think inflation might be subsiding somewhat, maybe not a lot, but subsiding and calming down here going forward. And the strong dollar would be part of the argument for that.
Mm-hmm. Well, I also would be thinking here about what the interest rate, metals like gold and silver, and also bonds. So let's look at those three. So let's go to actually yield, 10-year yield. And we've been commenting a lot on this because this is a very important indicator for us of just, the economic activity and the inflation and so on and so forth. So we've seen a very interesting apex type of shaped accumulation that was followed by a major sign of strength. And then our comment was that we are in some kind of backing up action. And we said that, actually, ironically, somewhere here, that we're going to go up from here. Now, we did not overcome the previous high, and we stopped. So we produced a change of behavior, which was suggestive of a trading range. So we are currently in the trading range, but kind of close to the resistance, which still suggests some strength. So I think, Bruce, that we need maybe a little bit more time here to consolidate. I wouldn't be surprised if the trading range is a little bit bigger in terms of the height, something like this, where we could potentially, for a short period of time, just pause, but then still have the trajectory to the upside. Would you agree with that?
Oh, absolutely. I think that that's probably, my expectation is it's going to be just a big trading range for the foreseeable future. And that these yields, I think there was a lot of I guess, opinion that yields had to go a lot higher. And we were starting to see accumulation type structures. I got to be careful of my language here, because we were seeing accumulation for bond prices and distribution for bond yields. See, it's kind of convoluted, but which meant that we were seeing the potential for rates to drop. And this is at a time when there was a tremendous opinion that rates could actually go higher. A lot of people were really surprised by that, and that was really that period of that we had here recently, say in April to June, and so on. So I think that we're probably range bound for the time being, but also keep in mind that the Fed has indicated that they're in a tight money situation right now, that they are actually going to potentially raise rates, and they're going to tighten, diminish QE purchases and so on. And all of that could have the effect of, making the dollar stronger, and could have an effect on yields, but I think that would potentially keep yields in a trading range.
All right, let's switch really quickly to bonds. So this is TLT, the 20-year Treasury bond ETF. And yeah, we've had some comments here, Bruce, on the trading range. So let's refresh our memory what those were, and what do you think is the next intermediate move for TLT?
Well, TLT is in a classic, looks like reaccumulation structure. And remember, higher TLT prices means lower yield. And so if TLT has a jump above that 152 level and can get above it and consolidate in a tight range, that'll be evidence that we might be completing a reaccumulation from a Wyckoffian perspective. It is possible that we may need to go down from this resistance area back down towards 46 or 44, 146, 144. But any ability to be able to hold in the top half of this range or jump up and out and consolidate, I think would be super constructive for higher bond prices and lower yields going forward.
All right, and I'm looking at the time, Bruce, 3:42. So just kind of trying to finish our market discussion here, but we still have to go through three assets here. So gold, speaking of US dollar, speaking of interest rates, gold is a very interesting case for us just because it has been an enigma for some time. It had a lot of directional changes. We kind of observed this rally and we said this is a major change of behavior, suggesting that either we are stopping here and we're going to go into some kind of trading range, or alternatively, this could be a sign of strength, which is going to be followed by the backup action. So the backup action was very quickly negated by these two bars. This is where volatility came back. There was a lot of selling, and that kind of destroyed the whole idea that we're going to have a backup. So trading range then. Okay, well, what kind of trading range are we going to have? With a lot of volatility, as we have had volatility prior, to this trading range, where we have a shakeout type of action into the low of August. And it's a very interesting low that was created, because even though supply has increased and volatility has increased tremendously, we're still not producing the commitment below the previous support level. So with this non-commitment and diminished result to the downside, that was suggestive that at least at the minimum, we're going to have some kind of testing action. So here's test number one, here is test at the higher level, and both of the tests are holding. And not only that, as we are trying to get out of this formation, we are having, again, somewhat of an upthrust action, where volume signature is increasing, and we're trying to break out above this red resistance line. We are not holding here and quickly coming back into the range on volume. And that is, again, suggestive that we are still in this formation. We have no clear directional bias here. And we should be approaching this as two things: a trading range, with different swings up and down. That's number one. And secondly, we should be waiting for some kind of change of behavior that would show us a confirmation of one bias over another. Bruce, I would be thinking here that for the bullish scenario, we just need to hold here. And we need to show that there is some kind of absorption character in the price action, kind of grinding up type of action into the resistance, and then the breakout. So that's the bullish scenario. The bearish scenario is also related to this line. If we break to the downside like this, most likely we're going to revisit the support and maybe even go slightly lower, revisit this support line right here. So I would be suggestive of trading on the intraday time frame and on the lower swing time frame, rather than just thinking about more of the investment type of strategy. Bruce, what is your view on gold?
Well, I like to look at the relative strength of gold or GLD to, say, the S&P 500. And when gold was going up 2018 to 2020, the relative strength was generally in a good uptrend. And literally since April, May of 2020, relative strength has been making lower highs, continues lower. Now it's at a place where it's the volatility or the relative strength is really muted. It's dull, but it's bouncing across the bottom. And until the relative strength of gold and the gold miners starts to turn up in earnest, I don't think gold can get out of its own way. And clearly that's what's going on here. It's just been in this trading range literally since November a year ago. And notice this important low at the end of November a year ago. And that low could very well be the preliminary support zone, which is roughly equal to where it is now. And so I think this is an important place from the perspective of accumulation, that it needs to basically settle here and not have the ability to keep going down and show additional weakness. And I'm not convinced it can do that. And but I'm completely open to the idea that we could be near the completion of accumulation here, but it needs to trade a whole lot better than it's trading right now.
All right, let's jump to something else. Let's jump to oil. And I have kind of like this theory about what potentially could be the structure for oil. And I think we are in the trading range. I mean, like, duh, this is like a most obvious observation, but hear me out. I think that trading range is going to extend, and it's going to be complex. So we're talking about complex trading ranges. With complex trading ranges, there are a couple of things that comes to mind. Well, first of all, duration, obviously. Duration just increases so much. Secondly, we have changes in bias. So we could go from one bias to another bias. So let me give you this example right here. All of this is of reaccumulation quality. There is nothing here that you could see of the long-term distributional quality. The local volatility in the, let's say, phase C, if we're talking about the reaccumulation, is a very common phenomenon in the reaccumulation. And all of the previous background signs were suggestive of the reaccumulation. So now suddenly we have this change of behavior. And by the way, we've talked about how we could have a much, much lower low based on the analog from the previous reaction. And even the top information in each case of the top was similar. It was just like, very easy analog to trade. But this is a meaningful, very meaningful change of behavior that suggests a switch from the reaccumulation bias to what could be a temporary distributional bias that eventually will come back to the reaccumulation bias again. So why is this happening? Why is this temporary distribution and temporary change of behavior is happening? Well, because we have an oil war. So we have the US that provides additional supply to the market through the strategic reserve. And we have OPEC countries, and specifically Saudi Arabia and Russia, who are trying not to get more supply to the market. So they are increasing the demand of, not demand, but by decreasing the supply, that produces the shortage and therefore produces kind of like the increase in prices. So we have two forces that are pushing from above and from below. So what does it mean? First of all, it means that volatility is still going to remain high. And secondly, that we're most likely going to be in the trading range after the change of behavior. So how would that look like? That probably could look like, and I'm thinking, could we produce some kind of spring action first before we start consolidating? Or maybe we are consolidating here first, then producing the spring. So this whole thing as a segment, let's say segment 2, is going to be of the distributional quality. And then from here, some kind of different change of behavior that would suggest that, okay, well, now we're gonna test and create another trading range. So, and we're gonna create segment 3, and only after that, we're gonna go up. So what that would do is we would go through the period where this war is gonna unfold, and it's unfolding right now. For the US, the prices that are stable prices for oil are going to be extremely favorable. And because right now oil is so politicized, so we want to get out of that for sure, because it creates the pressure on prices and creates kind of like this constant volatility of the price. I would be thinking here more about, if this would be the case, if this scenario unfolds, I would be thinking about what kind of trading are we doing here. So, and obviously there are some swing opportunities like this one, this one, this one right here, but the rest of it is just intraday opportunities. I don't see a long-term opportunities here, neither to the downside, just because of the directionality of the bias, or to the upside, just because of the inefficiency of holding on the asset for what could be a prolonged trading range right here, since this point, with a lot of deviations around the mean. So Bruce, that's kind of like my view right now on this big structure. What do you think about this idea?
Well, I completely buy the possibility for that. Now, let me just say that did you say you had my oil slides, point and figure slides?
Yes.
Good. So I can work off these. So this chart on the right, as our attendees will recall, we actually did this chart initially in January of this year, and we basically took the count of the entire accumulation structure of 2020, and we counted that up, and we got a count 8512 up to 11248. Pretty wide count because of the shape of the V bottom. So, and that's how we calculate the range. Look what we did though. We went to 8544, and noticed here so we got right up to the minimum count objective, and which I think is really fascinating. And we really made a point of this at the time. And then also, if you look over at the chart on the left, which is just a daily vertical bar chart of the crude oil, is notice that as that 85 area was struck, that was also the point at which it went into a range bound condition, had a final test, and then started to break down. Well, here's the thing. If you're to take a count, and the thing about crude oil throughout, as long as I've been tracking crude oil, it's a really wonderful commodity on a point and figure basis. And so it's remarkable how good the counts are. As you can see from the distribution count that we have on that chart on on the right, yeah, it's like, look at that. And it actually counted in the negative numbers at the low, which in fact is what happened. So maybe not minus $3, but it did go negative. But I want to point out here, looking at the vertical bar chart on the left, is that if we take that last point of support high up to around 78.88, that which is where the moving average is. When we take that rally, it bumped up into that moving average. And we can see over on the left that there's an initial, call it a preliminary supply point, beginning of October. And we take a point and figure count of that area across there. Well, where does it count to? It counts on a point and figure basis. I apologize, I don't have the point and figure chart, but it counts to $58. And look where $58 is. That's the March low. And so I think, and that just supports your scenario, Ramon, which is that I think that there's a really good chance that crude oil could just whoosh right down. Maybe it's got a pause underneath this upward sloping trend channel for a bit, but then I think it can go right to that $58 level. And I think that the concern there is going to be, and of course, I believe that this whole kind of overheated concern about inflation, which, you know, inflation's real. It's I think going to be with us long term, but we're in the process of somewhat unwinding that and the perception of it. And so the psychology is going to wane, I think, over the course of the next few months on inflation. Is going to become more of a back issue, but and part of it is because these commodities are going to come down somewhat. But I think that crude oil could be down in the $58 level here in short order, and then from there we go into maybe one of the scenarios that Ramon has laid out. And so for the time being, distribution is formed. We have ease of movement downward. I would expect that downward movement to continue. There's no reason to think that this is done yet. We know it's done because it'll build some kind of a cause, either for another redistribution or accumulation, sort of like what it did in March. Had a break, built a cause, and that cause was a bullish cause that ultimately led to higher prices. So I expect that somewhere down the road, we're going to get something akin to that again. But it's not here, I don't think, or it's not yet. Let's just say it's not yet.
This is just too aggressive. This is just too much for this decline to be over. However it's going to unfold, we have the kind of some kind of trading range and then continuation of immediate continuation to the downside. This needs more room to the downside because we need to have something like this for the bullish reaction to unfold, you know, where we could have diminishing supply character, not at the high level. Okay, well, last chart, and Bruce, we're almost at 4 o'clock here. So let's look at the Bitcoin. And obviously, you know, we had a lot of comments about the Bitcoin. This is the current stride, and we are right at this support level. So this is a very logical place for the price in the bullish scenario to stop, reverse, test, and then start continue going up. So locally here, I think what's important is just to break this most recent resistance in a decisive way. So committing to the upside, and maybe coming to the area of the stopping action, buying climax resistance, and forming another value zone type of trading range, and then breaking out of that. So this is how the bullish scenario would look like, in my opinion. At the same time, with all of the weakness that we have in the stock market and in markets in general, we are seeing that cryptos, and I was recording a session today for our Discord group together with Alessio, and check out Alessio's work, such a brilliant analyst that we have at Wyckoff Analytics, you know, on cryptos. You know, the whole idea is just to wait and see what's going to happen with the stock market and how that's going to influence the cryptos. What if the weakness in the stock market would get us down and we commit to the downside. Well, then that becomes a very interesting question, because where would we come? And we obviously have, two levels of support right here. And under what, circumstances, what would be the catalyst? Is the stock market the catalyst? It's kind of like all of this weakness in different markets would be the catalyst, or maybe some regulatory questions that, U.S. government is raising right now. That would be the catalyst. So we'll have to see. So Bruce, I would say that we just have to wait here a little bit and just to see what kind of resolution we're going to have.
Absolutely. And the only thing I can really add to what you said is there is a distribution structure that is formed at the top of this channel, and from mid-October to mid-November, and if you count that, it takes us down to around 49,000, which is not really very far from here. I mean, it is in an absolute sense, but in the crypto world. So
yes,
which
yeah,
is
could be just one day.
Vastly different world.
Hold on, so not even one day, like 4 hours.
Yeah, right. So, but I do get good counts from when I do crypto, and of course Alessio is he just does wonderful point figure work on the cryptos, and so I definitely refer you to him. But sort of a swing trading countdown to 49,000.
All right. Okay, well, Bruce, we are at 4 o'clock. We went through all of the markets. Wow, that was great. Let's just see what else we have in terms of the slides. Yeah, this was very interesting. So maybe you could quickly just walk us through the high yield ETF. So what do we?
Yeah, so that's really interesting. The chart on the left, and screen capture this chart and maybe study it. But beautiful point and figure count objectives that are created in the TLT over time. This is a very long-term, 2003 to the present, and you can see that there's somewhat of a distribution type structure. I did count it. The count is quite a bit lower, but I'm very cautious on that count in the notion that we're still in the upward striding channel. And so as long as we're up in that upward striding channel, I stay with it. And we could just spend a whole lot of time trading sideways, as we talked about today. I think we're up at 152 right now. And so we may be able to glide over, which could take months and months, over to that demand line on that chart. And so I would be thinking trading range here for a period of time for the TLT. But the chart that's so interesting to me is this high yield. Now, let me tell you why we like to look at the high yield, because the high yield is really sort of a litmus test for the economy. And for the stock market, because high yield tends to trend with stocks, and that also trends with the economy. When high yield is dropping in yield, rising in price, that tends to be associated with an economy that's getting stronger, improving, and growing. And when you get a decline in high yield prices, it tends to be associated with an economy that's slowing, might be in trouble, might be heading into trouble or recession. And so note here that I had a count off of the lows on this chart that count upwards to this as high as 33.82. We got to 32.80, like right into the middle of that count area. The reaccumulation count was a confirming count. That's the green count, and it confirms that area. Now, this is an old chart. That's like old data right there. I don't know if that's 422 right there or not. I don't think it is. I think it's later than that. But anyway, I think that might be September, October. But anyway, you can see there that we hit those counts. Then I've updated the chart on the right in a line chart, daily data, and you can see the classic attributes of distribution in this high yield ETF. You can see climax, automatic reaction in February, March, range bound condition, down to the area of support. Yeah, Roman is just doing a great job of labeling this. But the important part is that this is breaking down, consolidating, and declining ahead of the market. So this is confirming market weakness. It's also potentially confirming economic weakness going forward. Not necessarily a lot, but it does mean that we may be in for a period of potentially slowing conditions into the new year, and doesn't necessarily bode for recession or anything like that. But we do want to be really, really sensitive to watching this. And so I just encourage you to keep an eye on this, and as sort of a litmus test for what's going on in the economy and the stock market. And I think the fact that this is weak here, I think, is a leading indicator that stocks also might be weak going into the end of the year.
Mm-hmm. Yeah, fascinating. And yeah, most definitely high yield is such a great indicator, of the economic and market activity.
Right.
All right. Okay, one last chart really quickly. We've talked about this last week, guys. This is ARK compared to the analog of a Nasdaq Composite in 2000 and 2001. So we kind of, when we look at ARK, what are we thinking here? High growth stocks. And you kind of see the picture from this ETF, which is very resemblant to the top and the subsequent major change of behavior of the top in Nasdaq in 2000. Then elements of the short-term reaccumulation range, which leads to what? Which leads to the rally. But this rally is not that strong. It can't even overcome 1/2 of the decline, kind of the same structure. And then from there, attempts to go down and go up again into the lower high, failure. And we have multiple lower highs here, and they are the signs of failure with this small minus sign of weakness in the middle. So that's kind of like the only difference that I see in the structure. It's a little bit more complex redistributional structure right here. So I would divide again, like this whole idea about complex trading ranges that I'm kind of developing as we go through a lot of charts right here. Look at the first segment. So this is a distribution on the way down, by the way. So they're distributing as the price starts to go down. Then second segment is more of the reaccumulational bias. Then the third segment is of the redistributional bias. And then off we go. Here we go into sustained downtrend. And the way how we are going down in ARK with the increased supply, with the increased volume signature, with the increased velocity, increased momentum, increased downward spread, increased result to the downside, with the commitment to the downside as well at the correct places where breaking down. This is all suggestive of the distributional qualities. And this is what's happening under the hood. I would say, like, high yield, Russell, and ARK are probably the most three significant charts, Bruce, if we're looking at the distributional or reactionary, patterns in the current market. And then S&P and Nasdaq 100 is just being kind of like deceiving because of those big mega cap stocks. What do you think about this chart and just this whole idea that under the hood, we're actually, experiencing the distribution?
So what you're doing is you're doing an analog to the .com era. Mm-hmm. So that top chart is the .com era, which was a number of people have referenced concerning the current environment. And of course, what I'd like to point out here is we were talking about the Nasdaq 100 and how great it's acting. Those are like the super high value mega cap growth names that are the general, so to speak. Well, this is the dynamic growth names that were underneath that a lot of people have been trading, this is what they're doing. And so one of the ways we like to look at this on a regular basis is we'll look at like the percent of Nasdaq stocks above their 200-day moving average, or we'll look at the bullish percent for the Nasdaq comp or the NDX. And it's amazing how closely correlated those indicators are to ARK, more so than they are to the Nasdaq 100, which seems to be walking alone. And so this, I think, is so fascinating because it really is saying that under the hood, as Roman would say, under the surface, that there's a lot of weakness that's taken place in the really dynamic growth segment of the market. And you can really see it in the bullish percent. You can really see it in the advanced decline. You can really see it in the percent of stocks above their 200-day or their 50-day. And the ARK is just a reflection of those stocks. So it's like an index of all the stocks that aren't like the super big caps. And I know they own Tesla and they own these other big names, but they don't own them in a market cap type relationship like these indexes are calculated from, which is almost impossible to do for a portfolio manager.
Yeah, fascinating. All right, Bruce, we're at 4:11. Let's go to our selection. So for those of you who are guests or you just watching this recording for the first time, our concentration during these sessions is on two major themes. It's the analysis of the market and then an analysis of the selection of stocks or any other assets like ETFs, maybe some futures. We usually would use the stockcharts.com platform to go through our top-down analysis. And today we're going to just do exactly this. And I think that this is also going to be very, very telling for us, Bruce, to look at the sectors. We haven't done this maybe like in several weeks. So just looking at the most recent decline, it just so telling. I mean, look, let's say at the communicational services. We're breaking to the downside after a change of behavior, after a trading range, which is redistributional trading range here, or distributional trading range. The moving averages now are above the price, and then the relative strength is just phenomenally weak. And then we have multiple, sectors that look somewhat similar to this. I mean, industrials, when we look at the relative strength, that just, in the persistent downtrend. Look at the staples, persistent downtrend. Look at the latest trend of the relative strength in healthcare, down. Look at the materials, which was in the down and now kind of like basing. But we have quite a few sectors, Bruce, that are exhibiting that weakness relative to the S&P.
Yeah, it's not a pretty picture right now. And I think that relative strength is, we talk about endlessly, and of course people get tired of hearing me say it. I think relative strength is our X-ray vision. It's one of our superpowers. And so you can see, for instance, let's just take the example of the industrials on the top right. And so here's the relative strength, and look at the persistency of the downtrend in the relative strength. And even when industrials are rallying from late September into November, note how the relative strength is not able to get a head of steam and really get into gear. And at the final high in early November, you have a lower high in the relative strength at the peak. And that looks like somewhat of a dynamic rally in the industrial sector. And the relative strength fails at the end. Contrast that with technology. And so technology is where really, most of the really good action has been, semiconductors and some of the mega caps. And note how the relative strength is totally confirming the index price on the way up. And even when the technology went into a reaccumulation from August into October, the relative strength was only able to really go sideways for a little while and immediately got back above its moving average. And so, and then also the other thing I would say here, Ramon, is look at the flight to quality places, utilities, bottom left. So there, all of a sudden, utilities are starting to point upwards, which might be where, that's where investors go when things get gamey in the market. Healthcare. So maybe healthcare is making a little bit of a base in here. And so you can see that going on. So I'd be keeping a close eye on healthcare, and then staples is another place where people tend to hang out, but there's been a lot of weakness here recently in that recent drop. So you got to be super careful with these different segments of the market. So anyway, I see a market here from just looking at these sector indexes and the relative strength. It looks like it's trying to get defensive.
Just looking at because all of these sectors represent like the overall market, it just feels to me that we need to go lower and we need to capitulate lower. We need to have something dramatic, where there is a lot of exchange between of shares between the weak hands and the strong hands. And I don't see that yet, and I think it might be coming, just because this is not a resolved pattern to me, because this is not how accumulation usually would start. We need some kind of a complete fearful event to take place before we invite big money to commit a substantial amount of money into the market, and so far I don't see that. Yeah, a washout, exactly. All right, well, with that, let's jump to stock charts. So we usually go to the sectors, and Bruce, I put here 1 week for the period under the observation, and look at all of the sectors. So all of them, including, by the way, utilities, are down. So health care and technology are obviously outperforming. Utilities is also on the top 3. And I would probably be thinking, okay, so what's the strategy right now? I mean, a lot of volatility in the market. What is the opportunity? Well, obviously, you have to prepare for some kind of capitulation event if it comes. Trying to figure out what are the stocks that are strongest. So that would be my selection algorithm for the bullish scenario. And then for the short-term bearish increased volatility type of scenario, I would be looking probably at the bottom here and would try to figure out any type of groups or stocks that are exhibiting, some kind of weakness. So what would you prefer us to do, Bruce? Which way would you prefer to go? Let's do both.
Yeah, let's do a little bit of both. I know we don't have a lot of time, but
we don't have a lot of time, and we're pushing. So we're probably going to finish like at 4:45.
Yeah.
Why don't we look at both? Why don't we look at the strongest for the last week and the weakest? And well, let's start with the weakest. Let's start with oil, and obviously, not oil, energy. And obviously, oil has been very weak, so that translates also into the energy sector. Okay, so what I like doing when I look at the symbols here on stock charts is just to hover over the symbol and see the structure right away. So to me, I'm seeing kind of like the upthrust scenario right here. Okay, another one already down, like on a sign of weakness type of bar. Next one, close to the support, so even weaker. And again, off the top. So why don't we look at the integrated oil and gas? And then what I could do is I could do probably, let's look at the percent change. And let's just kind of like
so
see.
Just so everybody knows, U is generally market cap for the,
yes.
And so they break it down large, medium, small, and then some that have no market cap calculation.
Yes. Trying to quickly find something of interest. Let's look at half. Okay, so what do you think here? Not necessarily the best structure that I would say. Yeah, let's find something else. Okay, how about Suncor? Okay, well, I know that you like this type of patterns where that go into some kind of upthrust situation.
Yeah, so you can see actually, look at the series of diminishing upthrusts, poor man's momentum. And so you can see there that there's just a very minor climb above the June high. And also note that on the relative strength at the bottom, that the relative strength can't even get up to the area of the June high. So that is in and of itself an upside non-confirmation. And then also in November, that as there's an attempt to test in late November, the high that was made, sort of almost like a climactic surge on an upthrusting action in late October, that there's a lower high on the relative strength too. And then the response to that is immediate weakness. And so I would say this is a very, very vulnerable stock here. There's yield in this stock, so you got to be careful, for people that like to speculate on the short side. So just FYI, be careful. But that looks to me like a month-wide distribution type structure. So what I would tend to do, Ramon, is I would zoom in and look at the intraday of that period from November back to October and see if I could identify the Wyckoff distribution structure in there. And I'm not saying you should do that.
Yeah, and it seems like we have one. Like supply is coming in here, demand is decreasing, attempt to go up, lower high, failure, gap down on increased supply, and then increased supply on today's bar that negates, this climactic bar. So there are quite a few distributional signs.
And note that in June, there's a distributional type structure after a climax, and then a breakdown into a sign of weakness in mid-June, the rally into a lower high, not confirmed by relative strength. So the relative strength is making a lower high too. And that sets up a distributional structure, and then look at the weakness that occurs from June into August. So it's a swing, that's a swing trading, very small swing trading structure, but they're all over the place. So
yes. Okay, let's go to something else. Let's go to something weaker. Let's go to exploration and production. Let's just have one more. Okay, and let's look at something mid-cap. Okay. All right, what about this one, Bruce?
well, again, so we go back and we can see in June that there's an upthrusting. You have the March high, and that creates a sort of a distributional type structure. Look at the failing rally in early July that can't get up to the prior high. And then note in the relative strength how there's a distributional structure in the relative strength at the same time. So that produces a reaction, kind of a low price stock, but now we've had a very minor upthrust and it could not hold. And you have distribution in the relative strength also. And this is just a stock that looks like it's, for sale. It's going to go lower.
Yeah, this short-term weakness kind of suggestive that oil still has some room to go to the downside.
Yeah.
Interesting. Okay.
Yeah, but this could be interesting down the road for buying opportunities. It's just way too early to tell, but
okay, let's look at some in a different way. Let's look, if we're thinking that there's going to be some kind of capitulation event, or maybe the markets are going to stabilize here at these levels, and then the question will be, well, what is strong? What is behaving?
Let's look at healthcare.
Healthcare, okay. Okay, biotech, pharmaceuticals, equipment, and all of them are in the reactionary mode. So
yeah. So
I'm not even sure, what we would look at here. What's your choice?
I would maybe healthcare providers. Let's just look at that. Maybe there's something there.
Let's look at large caps. Okay, so something up today, unusual. Okay, here we go.
So you can see there in Quest Diagnostics note the uptrend in the relative strength there since early November. And so that's after a pretty long period of downward trend with a little climax in early November. And that looks like possibly a local accumulation from, say, mid-November back to late September. And then there was an attempt to jump up and out. And now we're, holding potentially above the resistance zone at around 150. And if it can hold there and then keep going, who knows, maybe there's an upward trend that's starting in that, potentially an early cause of sorts. And there's a very long-term uptrend in this group. And note that in September, there was a new high, another new high. So it just goes along, keeps making new highs, and now it's up into the resistance area. So anyway, this whole area might be reaccumulation.
Has to hold here because still, supply is coming in, and then we are having the lower high here, and off that we have supply coming in again. And today attempt to rally, and yet there is a supply tail as well. So has to hold here in order for us to start considering that.
Well, and if you get your event, your big supply event that that you've talked about today, none of these stocks are going to be able to avoid that. I would say it's just a question of degree in terms of which ones get hit the hardest. But I don't know that I would be trying to initiate trades into potentially a market that seems like it wants to. Supply is coming in, and these supply bars are big right now.
Yes.
I wouldn't be standing in the way of that. The thing about Wyckoff is we're always looking for the completion of accumulation at some level, whether it be reaccumulation or accumulation, to be able to time our purchases.
Yeah.
And so that's going to be really important. And we try to do that in these weekly episodes or these weekly chats.
Okay, well, I'm just gonna kind of like translate this in my own words, what Bruce has just said. We are in the reactionary mode, and it's not done yet. And it's not going to be done yet until we have either capitulation event or some kind of testing of the reaction that we currently have had. So once we have, either one or both, then we could start, be more aggressive with our selection to the upside. But for now, it is more about protecting your portfolio, maybe getting rid of some of the lagging stocks, moving your stop losses to logical places, and basically, protecting the equity as much as you can. All right, well, Bruce, we are at 4:30. So shall we jump to scanning? That's the last segment that we have.
Okay.
Okay, let's do that. And as usual, Johnny Scan is gonna walk us through another scan. So every other session, we have John coming in, and John has been such a great provider of scans that he develops on stock charts that are based on the Wyckoff structural analysis or Wyckoff concepts. So we've been enjoying John's contributions for the last couple of years. John, welcome back. What is it that you have for us today?
Great to be here. Hello, everyone, and big Wyckoff welcome to our guests out there. Professor Bruce, great to hear your voice today. We are going to take a look at a very simple scan that looks at who is performing the best, essentially year to date, who's going to win the race for the gains for the year. So our scan really is very, very direct. We look at the S&P 500 as our group. We're going to look at the weekly percent change over 48 weeks, which essentially we've got 4 trading weeks left, so that brings us to date. Simply saying that for 48 weeks, it's got to be greater than 0 as our percent change, and we're going to rank by that exact same criteria. So that gives us a very interesting 412 stocks out of the S&P 500, meaning there's almost 9% of those stocks that are not positive on this scan. So we see we have very, very high scooter values, notable exception with Nucor in the steel industry. Our weekly percent change is our last column, and that's where the sorts show up. And we see, for example, Moderna at 252% on the year. So really, really big numbers up at the top. If we look at the charts, we can see that the actual structure of the charts bear that out. We can indeed measure. There is a measuring tool on the annotation features of stock charts, and we see it's a little hard when you're running weekly because you don't know exactly where the week started, but we're starting basically at the beginning of the year and going up to date, and that's 252% on Moderna. Devon Energy, we just looked at some oil stocks, and that's our next stock. We see that it has almost 191% increase over the year, and that's trading at 26 times earnings with almost a 1% dividend. So that's interesting. Different take on oil exploration and production, which we saw some weakness there in our last segment. We have NVIDIA, a perennial favorite. That's our next stock, 157%. So even though a great performer, there were better performers on the year. The next stock, BBWI, it's a specialty retailer that has gone up 150% on the year. So again, by using very simple and direct scan language, we can pull information out of the marketplace for our own analysis. Here we have MRO, another stock from the oil patch, and that's up 144% on the year and looks promising at its current bias. So again, we don't always have to scan for a trade candidate. We can in fact scan for information about the market, and you don't have to wait for Barron's or Kiplinger's to tell you who did the best. You can run it yourself. So that's what we have tonight.
All right, great. I like the simplicity of the scan. I mean, to me, this is something more of almost like a market breadth indicator that you could run each week and or each month and just figure out how the numbers are shaping out. So you had like 412 candidates. I bet that before maybe we have had even more. So it's kind of an interesting simplistic approach to the breadth of the market. Bruce, what are your quick thoughts on this?
I just want to point out two things. One is each one of these examples had a magnificent accumulation or reaccumulation type structure that preceded its important move up. So these are classic Wyckoff structures. And we actually did a real-time case study analysis on NVIDIA a while back, and certainly it's been one of our favorites. And so I just want to point out that these stocks will build a cause and will indicate their intention to go up prior to going up, and you can totally see that in NVIDIA here as a reaccumulation. So that, I just want to make that point. And then the second point I would make is just that John has brought me kicking and screaming into the scanning world, and I now dutifully retype all those scans and I put them into my deck so that I've got them. And then I've even started creating my own scans, and I look at my scans every day for candidates and for attributes that I'm seeking. Some are John's, some are my own that I've tweaked maybe from his or from my own thinking. And but I just want to say that John has just done a wonderful job in helping us develop our abilities to be able to use scanning for Wyckoff. And that's something that a lot of people have asked for. And John's doing that for us, so that it's really, really fun and very productive.
Absolutely. You can find it and trade it.
So thank you much, John.
You're
All
welcome.
right.
Yeah.
Thank you, John. That was very effective and quick. All right, let's come back to our intro slide. All right, guys, for those of you who are guests today, don't forget that we have the promotion going on for this week until the next Wednesday. This session is recorded. It will be posted on YouTube on our channel, Wyckoff Trading Method. So check it out there. And if you have any questions, contact us. Visit our website, wyckoffanalytics.com. And if you have any questions, contact us at wyckoff.associates@gmail.com. Bruce, great session. Thank you so much. And
Thank you.
I'll see
Thank
you
you
next
all. And become part of our community. Come join us. Ramon was talking to me about some of the great plans that he and Wyckoff Analytics has for us for 2022, and it's going to be really exciting. So come be part of what we're doing. I think you'll really find value in it and enjoy it. So we hope to see you again.
Sounds great. Thank you, guys, and bye-bye.